Hi, Merlin. Thanks for arranging this interview, a technical interview. I'm Alex Black, President and CEO of Rio2 Limited. On this call, we have two of our key members of our technical team, Andrew Cox, COO, and Enrique Garay, SVP Geology. So, you know, we're happy to address any questions you may have from a technical standpoint in regards to our development of the Fenix Gold Project.
Great. Alex, thank you so much. Can you just give me a quick reminder of what your ticker is, what your market cap is, and what the name of your main project and where it is?
Yeah, look, our ticker symbol is RIO in Canada on the Venture Exchange. Our ticker on the OTCQX is RIOFF. We're also listed here in Lima, and the three of us are sitting here in Lima, Peru at the moment, talking to you. The ticker here is RIO as well. Our market value is very sad. It's 160 million Canadian. We have about 250 million shares on issue on an undiluted basis.
Great, thank you very much. And you say your market value is 160 million Canadian. But I mean, this is almost where we can kind of get straight into the discussion, because the NPV on your smaller project was only $120 million, and yet you're kind of expressing regret that the current market capitalization is not far off that NPV figure. So tell me, where the
disconnect is?
Yeah, the disconnect.
Okay, well, I'm regretting our share price, but I'm not regretting the gold price. So let's look at that. I mean, obviously our NPV was $120 million, but it was at a $1,300 gold price. And since then, a lot of things have changed. Gold's now nearly $1,800. And if you look at the sensitivity graph that's in our corporate presentation on our website, you'll see at $1,800, the project has a $400 million US NPV and an IRR of about 60-odd%. So, you know, there has been a disconnect between, you know, what we did back in 2019 from the point of view of preparing that model and that financial statement for the project to where we are today. And you know, the other thing that's happened is we're not just a company, and as you know, there's a lot of junior companies out there putting out PEAs, PFSs, etc., on projects which may never be built. We're actually in the process of starting construction on this project, and that still hasn't caught up with our valuation either. So that's why I laugh about the valuation. The good thing is we're fully financed through to production. We announced a couple of months ago the fact that we had done an equity financing, a small one. It was only about 35 million Canadian, that we entered into a streaming deal with Wheaton Precious Metals for $50 million, and that will top that up with senior secured debt with BNP Paribas for somewhere between $50 and $60 million. So the good thing is we're fully financed, so I can laugh about our valuation because we're not issuing any more stock anytime soon. You know, share price could go down further, and you know, what's the real impact? There is no impact, but you know, it's just a little frustrating given the quality of the project that we have.
Thanks. That's a good kind of introductory kind of explanation. You know, when I came to look at Rio2, one of the things that struck me was that you have got that development capital lined up, and yet the PFS from 2019 was just a PFS, and so you've obviously gone to that construction decision without having gone through a full feasibility study. And in the PFS, you know, there are some, you know, at the end of the executive summary, there are a set of recommendations. Could you just talk me through why you haven't published a feasibility study and what the conversation was with the streamer and with the debt provider? You know, do you have to get through a study to the level of a feasibility study before that debt becomes freed up?
Well, there's a few points here. This is not our first rodeo. I mean, obviously, We had a lot of success in the past with building 2 gold mines, very similar to what we're going to do in Chile, here in Peru with Rio Alto Mining. So Andrew and Enrique were intimately involved with the construction and also the operation of those mines. Doing a PFS on this project to the level that we did, and considering this project is very simple, it's a gold heap leach project. And since then, we've done some more work to demonstrate it's going to be a run-of-mine gold heap leach project, which is even more simpler than what we originally thought, because there's no crushing involved in the process route. You know, what we decided to do was draw the line on the PFS and go to detailed engineering. So Andrew and his team have been intimately involved, working in a lot of detail, putting together the detailed engineering. Now, the detailed engineering obviously consolidated what the capital and what the configuration of the project would look like. That was presented to the financiers. The financiers looked at that. We told them we're not going to do a feasibility study. Why? Because it takes more time. And this whole story has been, let's just get to production as quickly as we can. We're a junior company. We can't afford to wait. We're a single asset company. We don't have something else that we can fall back on while this goes into a long timeline. So the financiers understand that. So I think when people look at the fact that we haven't done a full feasibility study, the fact that Wheaton Precious Metals have said, yeah, we're willing to finance you, and BNP Paribas have said, yes, we are willing to finance you, subject to you getting your construction permit, which is further down the track. We're in the EIA approval process right now, should make investors feel relaxed about the fact that we haven't done a feasibility study, because we're working with some very experienced financiers. They understand exactly where we're heading with this project, and that's the route we took, simply to fast track this project.
That sounds as if Andrew and your team, and with you, Alex, of course, have done a feasibility study, but internally, without the
exactly. Without the technical report and the 43-101 and all those sorts of things. And let me tell you, the 2 mines we built in Peru, La Arena and Shahuindo, there were no feasibility studies on either of those projects either. Okay, so it's a matter of demonstrating, the components of the project, the capital related to the project. And once again, it's a very simple project. It's an ADR plant, no Merrill-Crowe, very simple project. And so all the work's been done. The financiers are happy with that work, and they're willing to finance us.
Good. I mean, I have seen projects without feasibilities come into construction without a problem, particularly when the metallurgy and the process route is
well, there's 2 companies. There's 2 companies doing it right now who are pretty well, followed in the market. Minera Alamos in Mexico.
Yeah, that's what I was thinking of.
Their example, and Mako Gold in Nicaragua.
Yeah.
I mean, Minera Alamos doesn't even have a resource statement. They don't even have a reserve. They're building a mine, and there's nothing wrong with that, right? There's nothing wrong with that. Obviously, they have a lot of confidence, and they've put out some recent drilling. We're in the same boat, except we've done a lot more work than those guys. Plus, we're starting with 5 million ounces of M&I, which was initially discovered back in 2010. I think that's what the market's missing as well. We've got a huge resource. In the case of Mako, for example, 200,000, 300,000 ounces. In the case of Minera Alamos, we don't know. And in the case of Rio2, 5 million. We're very similar to Orezone, who are building in Burkina at the moment, because they've got a 5 million ounce M&I resource and lots of upside potential as well. So I think, trying to fit in and trying to be, in a comparative environment with some companies like that is our challenge right now.
If I can butt in there, Alex, sorry, I'd just like to mention, I think there's some comfort too involved around the fact that we're using Stracon and HLC as 2 of our contractors to develop this project. The people that we've worked with in La Arena and Shahuindo, the 2 projects we've previously delivered. So there's a history working with these people.
Sorry, so what does Stracon do?
struck on a earth-moving civil mining contract.
And they'll be responsible
for the earth moving on the construction and the mining, the actual mining activity.
Okay.
And HLC are a plant design and construction company who will build the ADR plant and the associated infrastructure, who did the same in our previous two projects. So,
okay, so you've worked with both these contractors before?
Yes, and we've had two successful projects with them previously, and we maintain that relationship going forward based on the experience.
And that's another thing, just to elaborate on that, one of the issues we face in Chile is the gold mining industry is really small in Chile. And so gold oxide heap leaching is something that's actually not happening anywhere in Chile right now. It was in the past, up until recently, at Refugio, or the Maricunga mine, which belonged to Kinross, which is now on care and maintenance. So, Stracon and HLC are both based in Peru. They have Chilean subsidiaries, but we're exporting Peruvian know-how into Chile from the point of view of setting up a gold oxide heap leach project.
Good. Andrew, thank you. That's well, both of you, thank you. It's good to hear. Just coming back to the kind of your peer group, obviously Burkina Faso has got its own issues, which are kind of countrywide, but the issue in Chile and the issue with Rio Tinto is Rio2 is that you're capacity constrained by water, because your 5 million ounce ore body, you're targeting a smaller development pipeline because of water. Can you talk to me where that is? Let's recover that old chestnut once more.
Well, I'm going to put up if you don't mind, I'm just going to put up one graphic that will help explain a little bit about the water situation. And just give me 2 seconds. I need to. Sorry, I'm half blind here. Share the screen.
I don't take mine off when I'm on the screen.
Here we go. Here. So let me just talk about water, and I think you can see that right on the screen.
Yeah, great.
So yeah, when we approached this project right from the beginning, we all sat around a table and talked about the water situation and where we're going to get water from. When we bought this project, it didn't come with any water rights or any permitted water. So we all sat around a table. Andrew was there, Enrique was there, and I don't know who it was, but I think it might have been Andrew. When we were talking about this, we said, well, why don't we set up a starter project that's small, that doesn't have a big requirement for water, but how do we get, where do we get the water from? And I think Andrew might have said, why don't we truck the water from Copiapó? Because we knew there was a water retreatment facility in Copiapó, who the previous company that we bought this asset from had been speaking to. So that was an elegant way of fast tracking this project. And as you say, yes, it's probably we get to 20,000 tonnes a day. Well, that's our target rate of ore to pad. But maybe we can raise that a little bit, with a few more trucks coming up the road. We'll see how we go. But that's the starter project. And what I'm showing you here on this slide is where future potential water could come from. And, as you can see Copiapó there on the left. There's a couple of desalination options being developed in Copiapó right now, Nueva Atacama, which is the group that we're buying our retreated water from, and a group called ENAPAC. They're doing a desal project. They're looking for clients. So they want to put together a consortium of end users to bring up a pipe to where we are, and you can see where Fenix Gold is on the right. The other thing is we've had some very casual conversations with Codelco tailings, surplus water from tailings retreatment that they have at the El Salvador a copper project, which is in the area. And we could use that water potentially. We haven't done any work on it. And then also to the northeast of where we are, we know there are other available water sources that we could potentially tap into. So that is where, the various options that we have, we're going to dovetail into those at some point in the future. and build this project up. I mean, ultimately, we want to get this project up from 20,000 tonnes a day to about 80 to 100,000 tonnes a day. And at that rate of 80 to 100,000 tonnes a day, it'll produce somewhere in the order of 250 to 300,000 ounces a year.
Which is globally significant. The red star you've got at that you had at Lindsay there, that you've just taken it down, but that's fine. But what was that red star? What was that
okay,
link?
I'm just going to put up another. I'm just going to share my screen again, and I'm going to go to another slide. And Andrew, maybe you want to talk about this one.
Yeah, sure. So the red star you've identified, Merlin, is Lindsay. That's a piece of infrastructure we brought from a company that was previously called Minera Paso San Francisco. It's an old processing plant that used to process ore trucked from different operations to the north back into the 90s, I think, and it was shut down. I think it's started again in 2013, did some work and then shut down again, reprocessing ore from Arqueros to the north. And it's got a pre-existing camp, a land area. It's got a 5 litre a second water well, and it's got installed electrical infrastructure. So we purchased that asset basically because it's close to site. It gives us a base to work from. As you can see on the screen, it's at an altitude of 3,200 metres, which is comfortable for a camp for people to rest, to sleep. And we're hoping to use that as a sort of a kickstart to our construction. It's not associated with the EIA for the Fenix Gold Project. It's independent. So that allows us we'll start doing some prefabrication work, storage of components ready to be trucked up to site and installed as the construction advances. And it's obviously a starting base for our construction camp as well, which is a big head start for us.
Okay, and so that road is your access road in. It's not
correct. If you can see that the yellow line that says, I don't know if you can read it, says CH31. That's the international highway that connects to Argentina. And at about 3 kilometres past Lindsay, it branches off to the right, which is the red line, where it says 24 kilometres. And that's the access road to site, which is one of the first activities we'll be undertaking, is to improve that, regrade some of the steeper sections and widen out the curves, etc., just to facilitate the arrival and delivery of materials and construction machinery to site. It's perfectly usable now, but it needs to be improved for tankers and heavy trucks.
And sorry, I'd like to interrupt, but that's the big thing here. Look at the infrastructure. We're right on a main road virtually, and so it's a tourist road. It's not heavily used. La Coipa, which is a mine that's being restarted by Kinross, is just to the north of this slide, to the top of the slide. So we're in a great location from the point of view of having that infrastructure site as a staging point for the construction of the project.
And for that starter project, how many water trucks a day are you going to need going up and down that road?
When we get up to 20,000 tonne a day, it's approximately 72 trucks, which is 3 an hour. 3 trucks, 1 every 20 minutes roughly. So it's quite an important logistical exercise to maintain and keep that water arriving to site. That's the key to the project.
And what's the cost per tonne of trucking cost per tonne of anything really at the moment?
PFS study that we worked out the transport cost with Stracon, but they prepared the pricing for that. It was just over $14 in the initial 4 years. I think it was slightly higher because we've got some infrastructure we need to build, which we pay back to them over the first 4 years. It was roughly $14, top of my head, per cubic metre per tonne.
That's less than 10 cents per tonne per kilometre.
Our water cost, yeah, we haven't addressed it from that way. We've gone back to basics and done a ground-up calculation from the distances required, truck hours required, and then built up the plant rate for the cost of the truck, the diesel, the operator, the amount of trucks that are required extra to cover the maintenance period. So there's 3 extra trucks in the fleet for that. Then added all the indirect costs onto that. So it's a number developed by Stracon for us. It's obviously priced at 2019 prices from the PFS, and we'll have to update some of those costs, obviously, prior to restarting operation. And inflation's out of our control. That's something we'll have to deal with at the time. But
I'm looking at trucking costs at the moment for we've just done a feasibility study with Salazar in Ecuador, but I see other projects coming through with trucking costs, and I quite often see 14 to 16 cents per tonne per kilometre, which is quite a hike on what you've got down there for on the PFS.
Yep. Once again, I'm going back to it's built up from the ground with strike on the plant rates. It's open book calculation with them. We're happy with the inputs. The pricing inputs, as I mentioned, will have to be updated to today or next year's prices when we start trucking water. But there's a lot of efficiency when the trucks are owned by a company and they're working big hours per day. They don't stop. Each truck cycling 3 times a day, so the amount of hours that are accumulating per month or per year is very high, which brings a lot of efficiency into the ownership cost of those trucks per hour.
And it's the same contractor who's doing Stracon doing the water and doing the mining cost, the mining operation.
That's correct.
Alex, well, maybe Andrew, have you updated your mining cost per ton? When I had a look in the PFS, I wasn't quite clear about what the mining costs were. So if you could kind of give us what you're using, that'd be great.
At this stage, publicly, it's the PFS numbers. We don't spend a lot of time, to be honest, sitting down every day and updating, reacting to all the changes that are happening. We know fuel's changed. We know labour's probably changing. We know, and it's just not a good use of our time to be every week redoing the model and saying, "Oh, today it's this." Next week, it's what's it going to be? We're just focused on the PFS case where we maintain a good margin at 1,300, and we know with gold at 1,800 a day, we've got room there to accommodate the price increases. What we have seen, obviously, is a reduction in some of our OPEX due to the removal of the crushing circuit. That there's some rehandle that's been removed. There's the crushing costs itself have been removed. So there's some reduction in both processing and mining costs in that respect. But that's stuff that we're just managing internally. And I guess at the end of the day, we'll just be focusing on trying to maintain our production cost at about $1,000 an ounce in spite of possible increases. So that's sort of internally what we will be targeting.
So the conversations with Wheaton and with Paribas were behind a kind of an NDA, so they had your kind of updated numbers. Is that right?
That's exactly right. And just for the viewers that are listening to this, all a mining company can do is focused on costs, right? And there are lots of moving parts. Inflation on fuel costs, labor costs, deflation as well. Things move around a lot, but that's our game. We've put out in our PFS a AISC of about $1,000. So that's imprinted in each of our brains, in the other two guys' brains as well. That's our goal, is to make sure that our AISC doesn't go above $1,000. And that we do whatever we have to do to stick to that number. Now, meanwhile, while we're focusing on that, the gold price has gone up to $1,800 from $1,250, where it was when we did the pre-feasibility study. So, when that happens, it's like, okay, we've got a lot of buffer here, but we're still laser focused on the $1,000, right? And I think over time, we'll get that $1,000 down to about an average of somewhere between $800 and $1,000. I don't know where, let's call it $900. But so that's what a mining company like us needs to focus on and can only control is that. The gold price we can't control, inflation we can't control, et cetera, but we can control what we're doing on the ground.
In your presentations, you often show the NPV5 number, whereas lots of other companies.
We showed an NPV5.
Yeah.
You can put in 10, you can put in 15, you can put in whatever number you like. We don't care. I have never and I was CEO of Rio2 Mining, I have never focused on MPV. And the only people that focus on MPV from a mining CEO perspective are people that are going to sell their project. They're never going to build it. They're going to flip it, right? Or they think they're going to flip it. In our case, MPV is just a number. And once again, today, the MPV of that project, if you use the same metrics as we used in the PFS, is 400 million US, right? So who cares? You know, at the end of the day, it's all about that $1,000 ASIC and delivering the project. That's all we can control.
The reason why it's important is because if people
it's important for an analyst like you.
Exactly. If the market is used to
knock yourself out, Merlin, knock yourself out and build a model like all our other analysts that cover us, and there's a few that cover us. Most of them have got a target price of $1.20 to $1.40 on us. We're 65 cents right now. They've built their own models. They've applied their own discount rates, etc. That's the job of the analyst. We don't care about that.
No, but hang on. You've got the opportunity to.
I'm not selling the project, Merlin. Not selling the project.
No, you're not. You're not. But the why people like a good strong share price are two things. One is to deliver value to shareholders and to kind of deliver growth in the share price so that people who buy in at 60 cents can make money. And the other reason is that if you've got a project which is going to produce 250,000 ounces to 300,000 ounces a year, is that it doesn't become a target. So you may not want to sell it, but there's a reason why people like a good healthy share price to come with that.
You're talking about healthy MPV, not share price. Sorry.
Well, you want a strong you want a strong balance sheet. You want strong paper. I know you don't need strong paper in the short term because you don't need to raise capital, but long term you want your share price to go up so that investors coming in now make money, and that you don't get taken out if the project is a flyer. You want to be able to defend your company, and the stronger your share price, the better your defense. And so it's useful and it's really helpful to explain to the market that you've got a robust project. Now, Fenix.
Well, hang on. Whoa. We do that. There's a sensitivity page in our presentation, and once again, at $1,800 gold, we've got a $400 million MPV at a 5% discount rate. Apply whatever discount rate you want to that. Maybe it comes down to 300 million US, and we're 160 million Canadian or 120 million US Canadian company. That's for the starter project. It's got nothing to do with the other expansion of the project. So I think we show that we're a value proposition as long as we execute and deliver as we say. Right? Okay. That's the key.
Can I just stop you there? I mean, we know that Fenix is a low grade project. It's what's the average grade?
0.5.
0.5. So it's going to be really sensitive to things like operating costs. And you said that all you can control is the stuff that you can control. So you focus on making sure that ASIC is low. But there are key inputs such as trucking costs per kilometer or mining costs, which there's inflation out there.
Yes.
So that's going to affect your.
Once again, apply that inflation to the numbers we put in the PFS, and we'll still be way under the current gold price. And we will never know when we build this project. When we pour our first bar of gold, we're not going to guide anything at that point. You know why? Because we don't know. We've got to get a run into this project of about a 12-month period of production to understand exactly where we're falling into with regards to costs. We're forecasting in our PFS a cost. I think it's going to be better. These guys that are sitting on this call think it's going to be better. But at the end of the day, we have to deliver that. But we've done this before. We've done this twice before, and I'm not going to take anything away from what you've done in the past. I mean, you've been involved with a lot of
I'm not
companies.
A mine builder. I'm not a mine builder. I'm an explorationist.
That's the point. That's the point, Merlin. You're not a mine builder. There's 3 mine builders on this call.
But I have seen lots of presentations. You know, I've also been an analyst for 15 years, and I've seen lots of companies come through saying that they're going to be lower than benchmark, and most often.
And I'll give you, you know, Rubicon, Pure Gold, Heart Gold, the Coffee Gold Project, TMAC, all of them were all bullshit. Right? At the end of the day, they never delivered as they said they would. We've done this twice before. This is not our first rodeo. And this is a very simple project, Merlin. You know, one of the things you got to understand is that a gold oxide heap leach project at 0.5 gram with simple metallurgy is a dream project to get your teeth into.
Oh, I know.
Now, when you look at La Reina, when we built La Reina, the head grade at La Reina was 0.6 in the reserve statement that we put out at the beginning of La Reina. When La Reina is finished by Pan American at the moment in 2 or 3 or 4 years' time, the average head grade will be 0.38 grams. That's what will have been put on that leach pad. So even though I've said 0.5 is our average grade, we think it's great. Because our cutoff is going to be, what's our cutoff going to be, Enrique? Around 0.1, 0.15? Yeah. And so, you know, you've got to put a different mindset into what we're doing as opposed to some of these high-grade underground mines which have got ground condition problems or dilution problems and this and that. I mean, we've got a great, you know, large disseminated ore body. And what I'd like to recommend to listeners is go to our website, go to the Atacama. In our news releases, there's a section on Atacama Pacific where we've archived all the press releases from 2010 through to when we took them over in 2018. All the drill results are there. I mean, if we were putting out those drill results today, everybody, I mean, we'd be a much different company. But the thing is, we're now building this asset. And let me tell you that our experience and the experience of our financiers, the experience of all our contractors and consultants are that we're sitting on a very simple, straightforward project that will be impacted from time to time because inflation doesn't stay around. It goes up and down. Cost of oil goes up and down. The cost of reagents go up and down. But we will manage that, and we believe very strongly that our AISC is going to be around $1,000 an ounce or better, and that's it. I mean, we got to bring this project into production, and let us prove our point. Now,
Alex, well, I know you've got lots of moving parts, but when are you going to finalize, for example? I mean, so I've got a little bugbear in my head at the moment, which is
I can see that,
which is trucking. You know, I've got in my head the trucking cost, the Stracon. What
we're going to do, Merlin, when we start production, we're going to get you up there for 6 months driving one of those trucks, and we'll get you right into it.
When are you going to lock that cost in?
Lock what cost in?
When are you going to finalize the? Or is there a floating element to it? I mean, the Stracon contract.
It's an alliance contract, so at the end of the day, there are no hard cost elements. It's based on an open book cost plus model. So we will develop that cost with them as we go. Like I say, we'll start to reworking it. I mean, Stracon are mobilising into Chile now. They're requoting all the equipment prices because, as you would imagine, the PFS was quoted on 2019 prices. So internally, we'll have a better idea in the next 6 months going forward as to what that water cost will be like. Like Alex said, we're not planning on publishing anything. And at the end of the day, we're not going to know until we actually start doing it. And that's something that any small operation that starts with a junior company, it takes several months to bed all that down. You know, there's production reporting, there's cost reporting. The systems all got to be put in place, and people have got to be trained, and that information's got to be consolidated and presented in a format. And when you're starting mining on a peak of a mountain, so your numbers are not going to be great until you open up space, get benches going, get area, and the trucking will have to bed itself down and start finding its routine, its rhythm. like Alex mentioned, I think it's we're going to be 9 months to a year before we really have a good understanding of what our real costs are.
And Andrew, the fleet we're using, the truck fleet we're using, talk about that, the size.
Yeah, this is just worth mentioning, I guess, that the mining operation is small equipment. We're not opting for big yellow Tonka toy style trucks. There'll be small 43-ton 8x4 road trucks like Scania, Volvo, and Mercedes produce. Heavy capacity for mining, which is where we get to the 43 tons. That's something that we've done before, and we started La Arena like that. Shawindo started like that and is actually still running like that. So our mining costs are based on very good numbers that Stracon have. They're still operating in Shawindo. It's adjusted to Chile purchase prices at 2019, so they'll be internally re-evaluated, and we'll have an idea of any sort of changes, if there are, and what the plant rates will be for that equipment, as it's all open book. But it's a different scenario from a big mine. It's really a small project with small gear. That's just important to put out.
And Andrew, is the altitude at Fenix the same as the two operations that you built in Peru?
It's higher. It's 1,000 meters higher approximately than La Arena from a mining point perspective, but nothing that hasn't been done before. The operations in Peru working above 4,000 meters. Stracon have worked at El Briquel 4,600 as well until recently with similar trucks.
Okay, good. So Alex, I mean, it's in some ways this is the benefit of a DFS, is that you get the numbers out and the people kind of are less twitchy about it. It's going to take 9 months to 12 months before you've got a handle on kind of the delivery. So what are the catalysts in the near term that are going to drive the re-rating of the project that you can point people to?
Well, we're in the process of finalising the definitive agreement with Wheaton Precious Metals on the stream. That's taken a bit of time because Wheaton are pretty busy with lots of other things around the world. And also we've just come out of the summer holidays, so that's impacted us a bit in timing. But anyway, we've got our own money. We don't need that money right now. EIA approval is guided for March, Andrew, at this stage, around March.
Still the current thinking, yes.
Yeah, so EIA approval is a milestone for us because that allows us to pull the second tranche of money from Wheaton. The first tranche is 25 million on signing definitive agreement, second tranche of 25 on EIA approval. And right now we're starting to work with BNP Paribas on their due diligence, their technical due diligence. I mean, they've done some, but they're getting into more detail for the senior secured, which comes on at construction permit. And, we're guiding that if we get our EIA approval in March, we get our construction permit when, Andrew?
Approximately June.
Approximately June. So that's when we get the funds drawn down by BNP Paribas. Also, the other thing that's going on, as I alluded to before, we're looking at water options for the expansion of the project. And one of the things we want to do before we get to production on this project, the 20,000 tonne a day project, is put out a study that shows what this project can grow into, which sort of answers your question, Merlin, about, where's the value proposition here. And so that hopefully will be embarked upon in the next few months once we've nailed down, one or two of these options.
Okay, great. Enrique, I'm sorry we haven't drilled down much into the geology today, but it's a fantastically robust ore body. Of course, I am aware of the value of oxides and a disseminated ore body, which is internally homogeneous. So that's for me, it goes without being said.
But there are exploration potential. We can grow. There are lots of room to keep growing inside the resource pit, and also we run soil sampling on top of the Fenix Gold deposit, and we found that the deposit is open to the south, and we did a soil sampling across the property, and we found another target, what we name it Antares, which has the similar mineralogy and ore type as Fenix, black-banded veins, hosted in a breccia and domes, which is located 7 kilometers northwest from Phoenix, inside our property. We are controlling 100% of Antares. No, that's the brownfield that we are going to develop. Okay, the deposit is as you said is homogeneous, and the other beauty of the project is the deposit is outcropping. The beginning it will be the first blast will be ore, you know, and the stripping for the resource pit, the reserve pit is 0.85, which is amazing. It's almost 1-to-1 ore in waste, no, and more ore, and high grade outcrop, yeah.
No, and I think I've publicly said, Merlin, that I think when time's all said and done, I mean, we've got 5 million ounces of M&I today. I think this project will be somewhere between, and we've got 1.4 million ounces in inferred. I think this project will grow to somewhere between 6 and 10 million ounces over time through expansion, exploration. And we haven't, what we're going to do is once we start mining, we'll probably pull up a couple of rigs and look at doing the inferred and filling in gaps and adding to the resource base. But we won't do that until then.
Exactly, similar as we did in La Arena, in Shahuindo, no? They keep a couple of drill rigs to convert the strategies, convert inferred resources into measuring indicated resources, and also discover more inferred resources, and year by year replace what we produce. No?
Great. Well, thank you all of you for spending the time and explaining things to me. I got a bit passionate in the middle. But
this is really good, Merlin. Look, I really appreciate what you're doing. I think it's good for a team like us, any mining team, to be put in front of somebody like you. And yeah, look, you've obviously got strengths and weaknesses in your experience in relation to what we're doing. But I really appreciate, and I think the guys really appreciate your way of handling this discussion. And because you got 3 guys against 1, and I'm pretty passionate, as you can tell by what we're doing. Yeah. All I can say to wrap up to viewers is let us execute and deliver on this project as we say we will. Mark us at that point to say, well, that was a disaster or it wasn't. And then let us get this thing into production and start producing gold bars, and let's see if this thing produces. We think it will because of our past experience, but we got to deliver, right? And please don't mark us down until we deliver. Let's see what we deliver. This could be a barnstorming project. I think it's going to be one of them. I think it's going to be world class. I don't want to use tier 1 or tier 2 or tier 3. I think it's going to be world class at 250 to 300,000 ounces of gold per annum for 15 years or so will probably be the run rate. And then all eyes will be on this project and on the company.
Alex, I think you've summed it up beautifully. You've got you 3 guys, but there's a whole team behind you who have come from.
Let me just also say we've got the best junior development team in Latin America. These guys are stars, right? It's not me. Right.
I'd like to put my hand up and say, well, one of the best, perhaps.
Yeah, you might have one in Ecuador, but I've got the best south of Ecuador. Anyway, so but no, our team is key to our success. I can tell you.
Yeah, and in many ways, you've summed it up perfectly for me, which is to say that you've done it before. You know what you're doing in terms of the costs. It's a relatively low grade project. So cost inflation will be a pressure, but you've also got the gold price moving ahead. And so you've basically asked for the market to judge you on what you deliver, which I think is a very fair approach. So thank you all for your time. Alex, Andrew, Enrique, thank you very much.
Thank you.
I look forward to the next one.